Hey option traders, for today's trade we're looking at a covered call strategy on steelmaker Steel Dynamics. So looking at STLD on MarketSmith, the stock has been a strong performer, rising 112% since July of last year. STLD most recently broke out above an 88.72 entry from a consolidation in October. Thanks to very favorable earnings, shares were launched nearly 20% over the course of just 1 week. Aside from a brief dip in early January, shares have been consolidating above their 50-day line for a while now. The stock is part of the number 4 industry group out of IBD's 197 groups, which is a very bullish sign. Along with the strong stock performance, STLD pays a 1.1 annual dividend. Investors searching for yield can further enhance it on STLD by using an option strategy known as covered calls. A covered call is a simple strategy designed to collect income while also defining a predetermined exit price at which you would sell the underlying stock. So say you buy 100 shares of a stock, covered calls can allow you to lower the cost basis of the long position via selling call options against your position. As the seller of the call option, you are obligated to hand over your shares to the call buyer at an agreed upon price or the strike price if shares trade above this price at the expiration date. In exchange for this, the buyer of the call pays you a premium. Any appreciation in the stock above that strike price represents a profit for the call buyer. But if the stock instead declines in value, the buyer would no longer have a reason to exercise the right to buy it for a higher cost. In this case, they just allow the contract to expire and lose the premium paid. So with all of that said, let's take a look at my trading platform and set up this trade in STLD.
So for this trade in STLD, we are simply looking to buy 100 shares, unless of course you already own 100 shares, then you won't need to do this part. The key part of this is we are looking to sell one May 19th expiring 135 call option.
So for this trade, a May 19th expiring 135 call option can currently be sold for around $5.85. This would generate $585 in premium per contract and increase the annualized yield of the stock significantly. STLD currently pays around $1.36 in annual dividends, so generating another $5.85 from a covered call in just 1.5 months provides a solid increase. The $5.85 in premium received also gives a small buffer on the downside of roughly 5.4%. That means that STLD could trade 5.4% lower between now and May 19th, and the covered call trade would still break even. The total capital at risk in this trade would be $12,000, and if STLD went to zero, that's how much the trade would lose. But as reasonable and careful traders, we would definitely aim to close the trade long before the stock ever dropped to zero. If shares close above 135 on the expiration date, the underlying stock will be called away at 135 a share, leaving you with a total profit of $585 in premium received, plus any gains on the stock from the price at which you purchased it initially. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us for our regular options content here where we discuss a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.